It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the Biden administration is on the brink as a 14.7% crash signals trouble for the U.S. economy. And as the president heads toward November, what he needs is a strong and robust U.S. economy to give him any hope to get reelected. And based on the data we see today, we are confirmed headed into a recession. But there's also some other danger signs coming. We see that inflation is indeed coming down, and while this may be good news for the incumbent president, it's going to bring something highly unwanted that could dash all hopes of re-election. But President Biden isn't the only one facing trouble. There's another president that's facing much bigger problems. We'll show you who he is and why his problems mean their economy is plunging much faster into a recession. Now let's go to Bloomberg, where he picked today's story up with a headline of new U.S. home construction falls to the lowest level since August. And this is a huge warning sign for the U.S. economy because the housing market is critical. In fact, it doesn't matter which economy, could be the U.S., could be outside the U.S. The housing market is absolutely critical to the growth of the economy, mainly because of all the jobs and prosperity it creates along with it. And this, as we see it now turning to the downside, suggests that we are indeed headed into a recession. And as we started the show, this is not good news for the incumbent president, as residential starts decreased a massive 14.7% in March. This is the biggest decline going back to the pandemic to 1.32 million annualized rate. This is now the lowest rate since August. The figure was, of course, weaker than all estimates. Why is that? Because everybody's been talking about how the economy is booming and how rates need to go higher. And what we're starting to see signs is, as we made the case on this show, that interest rates are indeed too high in the economy, far too weak. As building permits, which point to future construction, fell to a 1.46 million rate in March. Both starts and permits, though, were revised higher in February. We'll assume this will get revised higher too. But one of the issues that's facing the current administration is indeed the economy and the labor market, because when you go into an election, one of the key tenets here is you need to not be in a recession. Now, that doesn't guarantee re-election, but if you're in a recession, well, you can forget all hopes, and that means the labor market needs to be strong. But what the housing market is currently telling us, as we look at new privately housing units started here in blue, and we've got a massive amount of data going back to the 1960s against continued unemployment claims, we can see now just how important the housing market is to the U.S. economy and to the labor market, that everybody tells us is not going to break at all. But here you can see downturns in, of course, new home construction starts. That means continued claims on the rise. And you can see that here all through the 70s, that repeats over and over. Look at here, going into the 90s, we see a deceleration here. The economy is actually strong enough, but at some point it gives way. And next thing you see is continued claims rising. Happens here going into the dot-com bubble. Of course, again, going into the global financial crisis. We even see a small sign of that headed just before the pandemic. And look now, we see this drop in, of course, new home construction. And what does that mean? More people on the unemployment line as this continues to decline, which will make the case here of it's going to. Well, this means more people on unemployment by November. Again, bad news depending on what side of the political fence you stand on, as the single-family home construction dropped by the most in about 3 years, while the pace of multifamily starts sank to the lowest since the onset of the pandemic. Permits for both also fell. And again, there's a lot of jobs here at stake. So as more and more of these companies stop building new units, that means more and more people out of work, hitting the unemployment line. Of course, that means consumption is going down, as is inflation. And after ramping up construction in recent months, builders may be taking a breather. The inventory of new homes for sale, get this, is the highest since 2008. So you go back to, of course, the recession, the global financial crisis, when we had massive amount of inventory. Just the other day, we talked about Tesla's issue. They have a massive amount of inventory. Now, on the onset, inventory builds into the gross domestic product, makes the economy look good. The problem occurs is when you can't sell it, well, all of a sudden, you start to see prices come down in a big way, as, of course, builders will compete against other builders and the resale market. And part of the reason here is many will suggest, well, it has everything to do with interest rates, and many people believe they're just not high enough. Well, if you want to sacrifice the housing market to get higher rates, well, that's one way to do it, because that will ultimately lead to lower rates, as you can see here. As we know, the periods of high interest rates relative to the economy, you see a deceleration in units started. You see that here going into the dot-com bubble. Of course, even in the global financial crisis, rates really didn't go up that much, and you got a huge bubble that gets burst. You can see now we have this big rise in rates. It hasn't crushed the housing market completely, but we're now seeing signs that this could, going into the summer, be dangerous news, lead to massive unemployment. And that's what a lot of people don't understand, is they think rates need to go higher. But here's the thing, if you crush the economy, rates are indeed going lower, and in a big way. And these figures represent a blemish in the nation's recovery in the housing market, as mortgage rates have largely stabilized around 7%, and prospective buyers and sellers only slowly coming around to accept this as the new normal. Of course, they won't accept it once they're out of work, which is a dangerous thing, and that is indeed the risk here. As we take a look, it's not just about, of course, rates, it's about the banks and lending and the economy, because if the economy here was booming, this would be a non-issue. People could say, you know what, I'm getting enough pay raises, I'm getting more hours, my finances are looking good, I can afford the higher monthly payment, the higher down payment, no big deal. But looking at the bank situation here, they just don't want to lend. And we can look at how against housing starts, we see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, and we can see now the effects of banks constricting credit. That is where you start to see the onset of the slowdown. It's not necessarily rates to begin with, it's the fact that banks don't want to lend. Here you can see going into the dot-com bubble, of course, the bubble was bursting and the bank said, hey, you know what, we've had enough. But look at right now, banks start tightening standards, they start constricting credit, and lo and behold, the housing market inventory builds in a huge way. And something else that should be building in a big way is your trading and investing accounts. Let's take a look at one of these recent trades going back to January. Many people said, man, I wish I knew how to trade the oil sector. I wish I could have bought into energy. Well, you could have. We showed all our subscribers going back to January on the 25th. We have two programs, one that looks at machine positioning, one that looks at the technicals. If you would have held this to the peak, and we teach people, use stop losses to control your risk. Don't ride these things down. Make your money. We'll show you another signal. And that's the key, is what is our next big trade going to be? We've got a bunch of them as the market pulls back. Here you can see if you would just put $5,000 on this, you would have made 3 times what your investment for a year on this report. After you signed up for our other report, you still would have been monster ahead on this. And how do you do it? We have one that looks at machine positioning. We have a report publishes every day, shows you when these machines are major short the market, so you can trade and get in ahead of them. We give you videos on how I think you should trade it, and we even show you when they're extreme positions so you don't buy after they've gone long. And maybe you're a tactical trader, you like those things like the RSI and the MACD, but you find yourself getting in late, out early, and all over the place. We add a proprietary overlay to all of these signals. It's called Momentum Time Pro. Same thing, report every day. We put a video out on show you how I think you should trade the signals, and that is the key. And then we review them over the weeks. That's the difference. Take those blemishes off your trading report. Start making more money. 30-day free trial. Check the links in the description below. And with this market pullback, there's going to be tons of opportunities for our subscribers. We want you to make money too. As the sentiment is similar among builders, as an industry group, Metre leveled off in April, citing hesitation among buyers as they try to gauge the direction of mortgage rates. And really, is it about mortgage rates? It's more about the economy. They're trying to figure out if they're going to have a job, they're going to have the hours to afford these payments, because it wouldn't be an issue if the economy was indeed booming. And given the recent robust readings on inflation in the job market, investors aren't hopeful that the Fed is close to cutting interest rates. And boy, isn't that the truth. In fact, we'll look at a chart here in a moment that the Fed really doesn't respond to the housing market until it's too late. Of course, we learned that way back when from Janet Yellen, when she was just ahead of the San Francisco Fed. She was watching the housing market melt down in her own backyard, and she couldn't even see it. Well, don't worry, the Fed can't either. And here you can see housing starts now against the effective federal funds rate. That's shown in red. And what you can see is slowdowns in housing begin. The Fed thinks, no, we still have a problem. Then, oh, no, we have a big problem. And then they go on a huge cutting spree. You figured out by 1994, they kind of got it figured out a little bit. But by early 2000s, nope, the housing market slowed. The Fed then said, wait, we are late to this party. In fact, even in going to the global financial crisis, you can see the housing bubble pop. And the Fed didn't react till it was way too late. They were more on time under Jerome Powell here around late 2018, but this time he is bent on doing what the Fed does best, letting the housing market implode, and then they'll cut later, meaning they're going to have to cut faster and deeper than ever before. A lot of people don't believe that, but in a matter of months, if this is the early onset now of the decline in the housing market, watch out below, because it's all about the Fed and what they do to the economy. And one way they do that is by raising short-term rates higher than long-term rates, higher than the market would price them at. And that causes curve inversions here. And we're looking at the yield curve, which is 10-year yields minus the 2-year, showing inversion when that red line is below that horizontal green line. And what you can see as banks, of course, cannot lend at this because they make money on the interest rate spread. They borrow at the short term, lend at the long term. So when the short term is higher than the long term, well, you've got a huge problem in your business. That means you're selling products for less than what you paid for them. Well, you don't do that, and banks don't lend in that situation. And you can see that these curve inversions indeed lead to and exacerbate a slowdown in the housing market across all, again, every parts of this. But they're not the only ones. As we looked at China's home prices fall as a slump shows few signs of abating. And of course, we see that what President Biden is facing now in the housing market slowdown, as his administration is going to have to deal with the fallout from this. Well, China's a step ahead of us. But of course, the problems for the Biden administration don't end just the housing market. Let's take a look at China first here, and it'll show you why what's going on there is going to affect the U.S. in a big way. As China's years-long housing slump is yet to reach a bottom, according to Goldman, even as policymakers ramp up measures to revive demand and alleviate debt strains among developers. Worries over home values, unfinished apartments, and uncertain economic outlook are keeping buyers at bay, dashing hopes for a rebound during the traditional spring busy season. And this is an issue because, as we've said before, the administration, their Beijing, can do what they want to do. They can put out stimulus, they can pump the banks full of money, they can make it easier to get a loan. But if the economy is not doing well, people are not going to buy. If the builders do not look like they're solvent, which they aren't, people aren't going to trust them. And sure enough, that's what's happening. And that means home prices are falling. And I want you to think here in the U.S., if the builders are sitting on a record amount of inventory and they can't sell it, they're going to have to start cutting prices. Because remember, they're not borrowing at 0% interest rates here. Rates are fairly high, meaning their cost to sell on these properties, well, it's going to eat into whatever cash they've got in a huge way. Then at some point, they're going to get aggressive about their price cuts. It's going to backflow into the residential resale market. And that means, as we see in China, new home prices in 70 cities, excluding state-subsidized housing, fell 2.7% in March from a year earlier, and they slid 0.34% from February. That is not a good sign, as China's top leadership has grown increasingly alarmed about the property crisis and the sluggish economy. A number of state banks are making their strongest effort yet to encourage credit officers to approve loans for developers. You can only imagine what we're going to do here in the U.S., because one of the problems here is the banks are going to be also deep into a commercial real estate crisis. That's not going to be a good sign. And just as I kind of mentioned earlier, this decline in housing starts, you have to go all the way back to, of course, the pandemic, you start to see that is the last time we saw such a big decline. But this time we have record inventory, fairly high interest rates. Banks don't want to lend. You can see the builders are going to hemorrhage here and drive a big decline in housing prices. And something else declining, well, that's China's currency as they loosen the grip on the yuan by weakening the fix amid a dollar strength here. Now they're bowing to reality. I like that, of a stronger dollar, according to Westpac. Or how about the reality is their economy is continuing to weaken and no one wants to use their currency because currencies are in demand, well, when there's trade. And the People's Bank of China broke out of a holding pattern and set a weaker daily reference rate for the managed currency, implying some flexibility for it to appreciate alongside regional peers amid broad strength in the dollar. The offshore yuan slid as much as 0.3%. to the lowest since November in reactions to so-called fixing, which means the dollar is going higher. And this is going to be another problem for the Biden administration as we start to look at other factors of a strong dollar against the economy. Today, we got some data caused from the industrial production. Now we see it rises again on boost from manufacturing, but that's not the whole story here. Is the 0.4% increase in production at factories, mines, and utilities matched the prior month's revised gain. Mine energy extraction fell while output at utilities picked up. And manufacturing output rose 0.5% last month, led by motor vehicles and planes. Of course, well, if no one's buying, that's going to change soon. And rising by the most in a year since February. Excluding autos, however, factory production posted a mere modest gain of 0.3% in March. Now, one of the challenges here as we look at industrial production and manufacturing production in the U.S., as the dollar gets stronger and other currencies like the yuan get weaker, well, it's not good. That means, of course, demand is going to flow to low-cost manufacturers in other countries. And at the same time, progress has been made gradual as U.S. producers contend with tepid export markets and higher borrowing cost limits and capital spending. Input costs for commodities like oil have also been on the rise, and all these are issues, of course, for producers. We'll look at that in a moment. And yet, despite the pickup in February and March, factory activity was sluggish in January. In the first quarter, what we see is manufacturing production decreased 0.1%. And get this, marked the fifth drop in the last 6 quarters, but which much smaller than the other declines. And that's, of course, what we know is that is changing now in a big way. And you can see the effects of higher prices here as we look at the producer price index by final demand in red against industrial production in blue, both on the year-over-year rate of change. And we can see this push higher in prices has pushed up industrial production a little bit here. But we know that as the dollar continues to get stronger here, we're going to see, of course, business flow out of the U.S. to other manufacturers, and that means inflation is coming down. Now, for the Biden administration, that's going to be some good news. Problem, as I started the show with, it's going to bring something highly unwanted. Here we can look at capacity utilization. This is a percentage of U.S. factories that are being utilized. And when you start to get below this 80% line, well, it means inflationary pressures are indeed going away. And you can see that every time capacity utilization gets up to 80% and then starts to fall, well, inflation indeed comes down. And what that means is as we continue to see less demand for U.S. factories, less demand for U.S. housing, less demand for U.S. autos, well, that means inflation is indeed coming down in the months to come, which again, on the onset seems like good news until you realize it's also coming with a lot of more people on unemployment. Here you can see capacity utilization. You've noticed I've not highlighted this at all against continued claims. They're virtually mirrors of each other. As demand from U.S. factories goes down, there's less capacity. That means employers are not going to keep idle employees. They'll send them home, put them on the unemployment line. And as you can see, likely by November, this is going to unwind in a big way and means the U.S. economy likely now headed into a recession. We have confirmation in the housing market. By November, things look to be far worse. We'll only imagine what the Biden administration will do between now and then. Of course, we'll be there with you the whole way. As always, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.